At the July rate-setting meeting, the FOMC indicated that the hiking policy would become dependent on the data, with many forward-looking data points such as the prices paid component of the ISM survey showing a sharp decline. Many in the market have started to look for a peak in rate hikes and a potential pivot from the Fed. But if the backward-looking data remains stubbornly strong, will the Fed have to hawkishly surprise the market in order to cap prices? That's the big conversation. Although the Fed hiked by 75 basis points at the July FOMC, the stock market continued to rally, with many participants now expecting the Fed to pause or even pivot its rates policy. And this view is gaining momentum. But here we'll outline why the Fed may still need to shock the market. The equity rally that continued after the July meeting was well underway even before the Fed convened. The interpretation that the Fed may ease back on its policy path was retrospectively fitted to the price action that was going on already. The latest leg in the rally, however, started on July the 14th. It was initiated by a reversal in the US dollar, after briefly breaking parity with the euro, but then reversing off this psychological support. The 14th July was also the peak in the US dollar-yen rally. This pullback in the dollar gave the market some breathing space. And that's because the stronger dollar had been tightening financial conditions. The baton for tightening financial conditions had been handed over from the fixed income markets to the currency markets. The initial sell-off in equities this year was largely due to repricing of interest rates and yields, with both the 2-year and the 10-year topping out at about 3.5%. Higher yields were playing havoc with emerging market bonds. Furthermore, higher commodity prices were putting pressure on global growth, especially within Europe, where electricity prices continued to rise. Eventually, this slowdown became evident, and the rise of the dollar was part of that process. Global trade volumes were falling, meaning fewer dollars in circulation, which in turn was creating a short-term dollar scarcity, driving up demand for dollars and therefore pushing it higher. Even commodity currencies were starting to struggle because higher commodity prices were not being supported by robust volumes. The two largest components of the dollar index are also facing structural headwinds. As mentioned, the Eurozone is importing higher energy costs, and this has crushed consumer confidence. And these issues are unlikely to stop anytime soon. The Japanese yen should also remain weak because of the determination of the Bank of Japan to hold 10-year yields at 25 basis points. The pullback in global yields at the end of July did help initiate a reversal in US dollar yen, which had become overstretched. And this is because when global yields are trending back down, it takes some of the pressure off the Bank of Japan, because other fixed income markets, at the margin, become slightly less attractive destinations. But if global bond yields rise again, then the pressure for the Bank of Japan to dilute the yen will resume. Alternatively, if Japan's CPI continues to rise, that will also increase the need for the Bank of Japan to protect its yield cap, again diluting the currency. Whilst the peak in dollar yen was around 140, and that may be the peak overall, it is still reliant on many exogenous factors aligning in favour for Japan. So whilst the July FOMC may have helped the equity rally, the wheels have been set in motion much earlier, and much of the late July momentum may have been nothing more than month-end activity anyway. Equities had been overdue a bounce from a very oversold position, where sentiment had become extremely bearish. Now, the Fed themselves seem unimpressed by the market reaction to the July FOMC. Many committee members have since reiterated that capping price remains their number one priority, even if that's at the expense of some short-term growth. Whilst the market's pricing of interest rates briefly fell, it remains close to 3.5% for year-end, and these are roughly the same levels that prevailed before the FOMC. And it was the rally in the equity market that appeared to create the expectation for a Fed pivot, but this saw very little follow-through in the short-term interest rate markets. So, what should we expect if the Fed is determined to tighten more aggressively? Well, the yield curve has already started to vote, with the inversion getting deeper. And the inversion is where the 2-year yield is above the 10-year yield. And this has reached its steepest inversion since 2000, at around about minus 40 basis points. If the Fed were to tighten in order to cap prices, then 2-year yields should rise more than 10-year yields. But more probably, 2-year yields could rise, reflecting sentiment around policy, whilst 10-year yields should fall, expressing pessimism around growth. Expectations are once again that the peak in consumer prices is now in. But as we said before, a peak is not sufficient. Prices need to consistently pull back. But this view is now building momentum. The CPI data is out after we finished filming, but the forecast was for a decline in the month-on-month reading from 1.3% to 0.2%. This would definitely be within the ballpark required by the Fed, but it would need to be consistently followed up by other prints of around this lower magnitude. And one of the problems for the market is this battle between the forward and the backward-looking data series. The market has shifted its focus to some of the forward-looking surveys, like the new orders component of the ISM survey, which is heading lower. Although none of these are as extreme as either the University of Michigan Consumer Sentiment Survey or the NFIB Small Business Outlook. The Fed, however, will be focused on CPI data for obvious reasons, as well as the employment data. These are both, however, backward-looking in that they are an indication of what has already happened and are also prone to huge revisions and the impacts of seasonality. Take the recent non-farm payrolls data. The figure of 528,000 was a significant beat versus the 250,000 that was forecast. But this is a very volatile data set. And firstly, last year's data often undershot expectations of the rebound in the US economy. And this year's data is making up for that with consistent beats, even though more immediate surveys of the employment situation, such as the initial jobless claims, have been edging higher for weeks now. And the details of last week's data were also revealing. The big jobs gains were in the part-time sections of the jobs report, rather than full-time jobs. One person with 2 jobs is counted as 2 jobs in the payrolls report. However, in the household report, that same person would be counted as 1 person with 1 job. Therefore, the strong payrolls could actually be interpreted as a sign of weakness. But the Fed will still be worried that employment remains tight. One of the best ways to entrench higher prices within the economy is to allow a wage price spiral to get out of control. The Fed will not want that to happen, and so may respond aggressively to data that might be weeks, if not months old, and then prone to significant revisions in the months ahead. Unemployment in the US is usually at its tightest level just before a recession kicks in. So a tight labour market is not really a sign of a healthy economy. Both high and peaking levels of CPI and tight labour markets are often precursors to recessions or a sign they're actually already in one. We've already had 2 consecutive quarters of negative GDP, and although these can be revised higher, it should be no surprise that we are near or within a recession. But the real reason why the Fed needs to remain hawkish is that a pivot that supports growth will also support prices. Sustainable growth needs prices which are low and stable. This is because today's high prices are the result of supply constraints and fiscal stimulus. Unfortunately for the Fed, the government has just passed another fiscal package, and that will be fighting inflation with more inflationary stimulus. Therefore, the Fed may need to break something if they're going to properly cap prices. Whilst a recession has historically been the best antidote for higher prices, with CPI dropping often precipitously through a recession, a pivot today and a mild recession would just be kicking the can down the road. And that's what happened in the 1960s and the 1970s. CPI would rise sharply. The Fed would respond with higher interest rates, causing the equity market to buckle. The Fed would then reverse engines, but CPI would then make a new high a few years later. It was only in 1981 when the Fed really pushed interest rates to a level that was significantly higher than the prevailing CPI, and then maintained an aggressive level of real rates for most of the next decade. If the Fed allows CPI to rebound, then higher prices will kill growth before it can even build a head of steam. And that's because the market will reprice the curve in anticipation of yet another Fed flip-flop. And this is what happened this year. It was the market, and not the Fed, that took 10 and 2-year yields to 3.5%. It was the euro-dollar and the Fed funds curve that priced funding levels close to 4% in the middle of next year, and not the Fed. The Fed has been playing catch-up. In June, the Fed's dot plot briefly surpassed existing market expectations for rate hikes, but was quickly overtaken again soon after. And now people are saying that the Fed is being too aggressive, and yet their current interest rates and their dot plot are only marginally above where the market expects interest rates to settle next year. And knocking the Fed is a national pastime, but it's the market that tends to lead and the Fed that tends to follow. Although their guidance is absolutely key. If a 75 basis point hike is rewarded with a rallying equity market and then a loosening of financial conditions, which would be more, not less inflationary, then wouldn't this embolden the Fed to tighten by more at the next outing? Clearly, looser conditions give the Fed more room for more rate hikes. Therefore, a rising equity market is a double-edged sword. It provides relief, but it also provides an opportunity for a more hawkish surprise. Markets currently remain fixated on the policy response that occurred during the era of moderation, where CPI was generally low and stable and tended to rise as a consequence of growth. During that period, which lasted for about 30 years, the Fed was quick to support growth. But when we look back at the 1970s, the Fed had to raise rates to kill growth. And this is why the yield curve continued to invert into recessionary events. And today, we should probably expect the same dynamic, with the Fed continuing to raise rates even as yields at the longer end are falling, indicating that the policy is hurting growth. Because that's its intention. You need a recession to cap prices. Therefore, the Fed needs to break something, rather than reversing course just because the market is worried that they might break something. The equity market may now need to price an increase in unemployment and a decline in corporate earnings. The Q2 reporting season surprised on the upside. If the large cap corporate world is doing well while small businesses and consumers are suffering, then the Fed should still tighten further. The US yield curve should probably invert more deeply than the precursor to the dot-com recession in 2000. Interest rates may have to be over 100 basis points in excess of 10-year yields to permanently crush prices. And the small head and shoulders on the US 10-year yield does imply a target of 2%. Tech stocks could outperform, but that may be in an overall down market. The first half declines of the S&P this year were extremely ordered, with few signs of capitulation. Retail investors were adding throughout, whilst the meme stock frenzy has partially returned. Institutional sentiment is far more bearish than actual positioning, and even the short position in non-commercial, often called speculative S&P futures could be misleading. In 2007, the peak in the shorts took place just before the peak in the market, and they were longest towards the 2008 lows. Sometimes the professionals do actually get it right. And if the Fed does need to shock the market, then we've probably not seen the highs in the dollar. There's no fundamental reason for the euro to bounce off parity. It was a technical event, with the fundamentals at 101, the same as they might be at 99 or 95. But it was that bounce that kick-started this equity rally that then eventually led to expectations for a pivot. But this Fed's probably not for pivoting, at least not yet.